We'll make a start. Good morning, everyone, and welcome to our FDEA Market Insights webinar on the US market. Great that you can all join us today. Sun is shining. We've had bank holiday, so we're feeling really positive about hearing what we've got planned on the US market this morning. So this morning we're delighted to be joined by Steve Lanier from American Wealth Services, who is the US in-market expert for the FDEA. We're also joined by Jim Kilmer of the Opal Group, who are one of the FDEA service providers, and they do sort of back office services for exporters in the US. And we'll also be hearing from Michael Philpott of Whittard of Chelsea, who will be talking about sort of their experience in doing business in the US. We've got time for some questions at the end, so if you do have any questions for all three of them, please do pop that into the chat box and we'll come back to you. We'll also be recording this webinar and it will be available and sent round to all participants after later today. So that's it. So I'm going to hand over now to Steve, who's going to kick off the presentation. Over to you, Steve.
All right, thanks, Mel. Good morning, everyone, or good afternoon. I guess it's officially afternoon. I'm going to try to share my screen here. Is that coming through okay? Perfect. Great. Well, just a pleasure to be here. Thanks for the opportunity to FDEA and talk a little bit today just about some trends and opportunities in the US market. Kind of a rapid overview of kind of what's going on recently. And just a quick word about our company, just kind of understanding what we do. We've been in business about 25 years at this point. I say I still enjoy it. When I get up in the morning, I say, okay, let's go. So I think that's a good sign. And our focus is really helping non-US companies enter or expand in the US market. We do a lot of work in the food and drinks. That's our main sector. We do other sectors, but that's our main sector as well. Our main office is in Washington, D.C. I go between France and Washington, D.C., which is another story. But our whole focus is doing market studies, doing partner searches, identifying partners, and acting as sort of a marketing office for our clients in the U.S. So that's our quick area of expertise. And just to start, with a big, broad overview, the U.S. market, as I say, supersized market, about $2.4 trillion in terms of revenue for the food sector, which would include food service and retail. That's a lot of food. Americans like to eat. If you look at that, that's about 10% of our whole GDP is food. The whole market is maybe 24 trillion, and about 10% of that is food. It's slow growing at 1%, maybe 1.3%, they said in 2022. And most recently, food service is making a big comeback after getting hit by the pandemic. They said about a 12.7% decrease in 2020, which I was surprised. I thought it'd be bigger than 12% or 13% in 2020. But food service also includes different hospitals and retirement homes and so on. But food away from home continues to go up, about 56.2% in 2022, and that's almost the record that was hit in 2019. So food service is coming back, which I think is a good thing. So big market overall, slow growing market, and food service really growing at this point. But if we go down a little bit deeper into specialty food, then we see some numbers that look very interesting in terms of growth. About 9.3% in 2022, according to the Specialty Food Association. And that represents about 8% of all food sales in the US, and 9% of all retail food sales. And they think expected growth 5-6% in the coming years. So I think that's a very good sign. Sometimes our clients say to me, how do you define specialty food? What's specialty food? I say, if it's not a hamburger, it's probably specialty food. That's kind of my definition. And mainly our clients in the UK, in Europe, I'd say 8 or 9 out of 10 are considered specialty food in the US, even if in the UK or Europe, no, we're not specialty food. There's a pretty good chance you're going to be specialty food in the US. And that's partly because our food system is just not quite at the same level as the food system in the UK and Europe. But the good news, when you look at that specialty food category, it's high growth. Although what's very interesting, there was an unprecedented, and I quote the specialty food report, an unprecedented decline of almost 3% in terms of unit sales. First time in, I guess, in the history of tracking this, that unit sales have gone down, which is very interesting, even though dollar value is going up. And here are some of the top 10 categories. So you see, for example, eggs, unit volume down 21.7%, dollar value up 23%. So, and you see that a number of different bars and gels, sodas, fruits and vegetables, soup, fruit and pasta, beans. So really what's interesting, even though the dollar value is going up, the volume's going down. So it's interesting. I see this as sort of a not a bad thing. In fact, I think part of it, what we've seen in the last 20-some years, US consumers are becoming more educated, more sophisticated, more refined in their taste. I use the example of my family. When I grew up in Chicago, I grew up in Chicago, you know, there was Hershey's chocolate or Nestle's chocolate, and those were the two choices, basically. In the 70s and the 80s, that's all you had to, and coffee, you had Folgers coffee, or you had Maxwell House. Were you a Folgers house or a Maxwell House? Now, when I look at my nieces and nephews who are in their 20s in Chicago, and you see across the US, it's when you buy chocolate, what percent of cacao, what is the origin of the beans? Same for coffee. For wine, everyone's very sophisticated. Even back when I grew up, nobody really drank wine. Now people are drinking wine. And so I think there is something of an educational process going on among a lot of consumers, where we are ready to spend more money for products that we think are good quality, healthy, and we see that across the board. Healthy growing, different high quality going, and specialty food, which tends to be high quality, is growing. And even if unit sales might be going down, the average price of the units are going up, which I think is not such a bad thing, especially if you're a producer in the UK. You're going to be probably a little bit on the higher end in the system, and that I think is generally good news. So this is a trend that I think has been going on. Specialty food has been growing that 8 to 10% for years. I think going back 10, 15 years, I remember every year specialty food going up. But now we see unit sales for the first time going down, which is very intriguing and interesting, but not necessarily a bad thing in my opinion. The other area that I think is very interesting to look at is the private sector label activities. And I say it's kind of a tale of two cities. You've got this high growth in the specialty food area. You've got these sophisticated consumers. And then at the same time, you've got a lot of growth in private label products, significant growth. And now they say grocery unit sales are at a record of 20.7% in terms of penetration rate for private label. So you've got this sort of area of consumers, I think, going down a notch, and you've got consumers that maybe are going up a notch, or consumers like me, that some things that go up, some things that go down. If I really don't care too much about this, I might go down. If I do care, I go up. But it is sort of an odd occurrence of these two flows. I think a little bit of a downflow. And I think also if you're outside the two coasts, outside the West Coast, East Coast, or the major cities like Chicago, Miami, New York, Los Angeles, Washington, D.C., there you have lots of hubs of foodies and some more sophisticated consumers You might get into the areas outside of that, and you might have consumers more looking for the going down a bit and looking at private label. It was interesting. I used this quick anecdote. I was in Bordeaux. We had a wine mission. We work in the wine sector and the food sector. And I was talking to one of the producers, and he had this very kind of a heavy metal label, very modern label, very interesting. And the retail price of my calculation was going to be maybe $40 or $50 a bottle in the US. And I said to him, I'm not sure your label corresponds with the dollar value, $40 or $50. I'm not sure that's really going to correspond. And that was just my kind of quick opinion. He was asking me what I thought. And then an importer came up from Los Angeles. He said, oh, he tasted the wine. I want a pallet. I want 2 pallets. I got to have it. And I said, Alvaro, what's going on? What are you thinking? He said, oh, this is perfect. And I said, for me, I'm not sure the label really corresponded with the dollar. I said, no, I work with techies. I'm in Los Angeles. Money doesn't matter to them. This is perfect for me. And I thought, all right, there you go. And they like, modern packaging. This is it. I thought, well, I'm too old. I wasn't the target market for this heavy metal, cool label, modern label at a very high end. Because if I'm going to spend $50 on a bottle of wine, I want a stuffy chateau that says this is a good bottle of wine. And I think that anecdote shows, 2 things. Number one, that these, they're in the major areas, Los Angeles, techies, foodies, they're spending money, and that really doesn't matter too much. But millennials have a different viewpoint than sort of the boomers in the market. So you have to think about that in terms of your target market. But you look at maybe outside of that area, then you're looking more at maybe consumers going down a notch, and consumers everywhere with inflation are going down a notch on certain products. So something to take into consideration as well. One area too, we're seeing growth, just to do a kind of a quick note. We're seeing plant-based continue to grow significantly, about 44.5% over the last 3 years, which that's down a notch. The prior 3 years, I think it was 57 or 58% growth over the 3-year period. So still high growth, but maybe down a notch from the last 3 years. And plant-based milk is the most interesting, with 2.8 billion in sales. Meats in second place, plant-based meat. So again, I think this shows consumers getting sophisticated, consumers wanting to have good, healthy products. And that's really the trend that we continue to see in the US at this point. So just to kind of wrap up my quick 15 minutes of fame here, a lot of my clients kind of say, okay, what are the keys to success? And we've been working with clients and getting them in the market for 27 years. We work with importers and distributors and food brokers, and how do we get in? How do we get them to move forward? And I really say the quick answer: 2 big keys that I've seen over the years. One is story. What's your story? What is it that makes you unique? All the unique elements of your products, of your company, and you boil that down to 15 seconds, 30 seconds maximum, maybe. And working and developing a good pitch and story is extremely important to the US market. Every market story is important, but especially in the US, because in part, we have a lot of different players in the chain. You have an importer working maybe with a regional distributor, and then you have a food broker, and then they're working with the retailer who's talking to the consumer. And if you have a good pitch and story, that can be shared along the chain. And we've seen that. How do you generate interest with an importer or a regional distributor? Have a good story, have a good pitch. We say you want them to say wow in the first 15 seconds. That's a good story. And it just presents all the unique elements. In terms of you're eco-friendly, in terms of the environment, in terms of ingredients, in terms of the company, the values, the taste, the awards, anything can be part of your story. But we say to come up with a good story. And then second, in the US, follow-up. If anybody has seen my presentations before, this is not new, but I say follow-up, follow-up, follow-up. When we contact a potential partner for our clients, we contact them 10 or 15 times. And when we get a hold of them, they say, oh, you have good follow-up. This is really good. And I say in the UK, if you call somebody 10 or 15 times, they're going to call the police. And that's the cultural difference between the UK and the US. It's follow up. Now, the UK is a little more in line with the US than, say, France or Germany, Italy, but there's still a cultural difference, and it's not impolite to push. And in fact, I see that a lot of times. I'll talk to our clients in Europe, and they say, yeah, we had a good meeting, good first meeting. I sent him an email. He never responded. I don't think he's interested. And then I talked to the partner, the importer, the buyer in the US. Yeah, we had a really good first meeting. He sent me an email, and then he never followed up. I don't think he's very serious. And so you have this sort of, disconnect. And we say, okay, to really do a good follow-up in the US means to be a little aggressive, to keep pushing. Even if they're interested, they're not going to respond because they want to see if you're serious. So what we suggest, have a good story, do good follow-up, and you can increase your chances dramatically that you'll be successful in the US. So that's kind of my story. That's kind of what we're about. I think just from our activity, certainly an opportunity. It's a big market. It's just a question of finding the right niche, finding the right place for the products. But products of good quality are always interesting in the US, and I think are always welcome and always have a possibility to develop in the US. So I'll stop there and say thanks again for letting me be part of the trends today, and happy to answer any questions. I think we'll have some questions at the end of the presentation.
Thanks, Steve. That's really insightful. Thank you. Yes, if you have any questions for Steve about how to develop a good story, how many phone calls is too many phone calls, then please do put them in the chat box and we'll come back to you at the end. I'm going to hand over now to Jim from the Opal Group, and Jim is going to talk about how to fail in the US. So hopefully giving you some practical tips on how not to fail in the US. Thank you, Jim. Over to you.
Thank you, Mel. Is my screen up for you there?
Yeah, all good.
Okay. Well, good morning or good afternoon, everyone. My name is Jim Kilmer. I am the managing partner of the Opal Group. And this is going to be a bit of an unusual presentation, at least for what we tend to see at trade shows, where people say, what, are you trying to scare potential clients? You don't want them to come to the US, and that is not the point at all. We very much want you to come to the US, and like Steve said, there is a ton of opportunity here. But unfortunately, we see a lot of manufacturers coming into the market and making the same mistakes over and over and over and over and over again. So we're now hoping to get out in front of that. Just a bit of background, the Opal Group, we've been around since 1995, so we're coming up on 30 years, and we help overseas manufacturers operate in the US market. So basically, we do everything Steve doesn't do, really. We don't do sales, we don't do marketing, but we handle all of the other operations that you might need in the US. So the entire order to cash process, accounting, trade promotion management, supply chain. If you hire salespeople or a country manager, we handle all of the HR and benefits administration. So basically everything you might need. And here's a sobering statistic for you. 70%, about 70% of new brands launching in the US, whether they're overseas or domestic, will fail within 3 years. So why is that? Well, there's a lot of different reasons, but unfortunately, one of the things that it has done is it's created an atmosphere in the market, and it's created behavior in the market where retailers and distributors and other key players almost expect new brands to fail. And so as a result, it's kind of a no waivers, no favors environment where a lot of times they're looking for cash on the barrel up front. There are placement fees and slotting. There are other types of trade promotion that they expect you to do and spend that they expect and other expenses. And so sometimes as a new entrant to the market, it's very difficult to get what you might feel is a good deal from some of your service providers, partners, or customers. And the reason for that is that the customers have kind of been conditioned to believe that in 3 years, there's a pretty good chance you're not going to be around. So if they don't get their money and their payback up front, there might not be a long-term partnership to fall back on. And so this is another thing we're really trying to change that tide and get the word out there about what are the things that cause these companies to fail, because it's not just bad for the companies involved, it actually distorts the entire market and creates some behaviors that we would rather see an end of. Um, so quick disclaimer here: these are obviously the information that we are talking about is our experience and our opinion on the matter, and also this is just FYI a sort of abbreviated presentation. We actually give this as a hour-long seminar at some events, and I believe we may be doing that for FDEA later in this summer. But for now, you get the condensed version. So we're going to start out with a bit of a psychology presentation. And one of the big reasons why overseas manufacturers fail in the United States is because of psychology. And if you've not studied psychology, there's something called the Dunning-Kruger effect, which in brief basically is we don't know what we don't know. Or stated another way, the less you know about a subject, the more confident you are that you know everything. And so particularly for English-speaking countries and Commonwealth countries, there's a tendency to think, oh, well, the United States is just like us, only bigger. And so they go into the market thinking that many of the things that they do in their home markets are going to be directly replicable in the United States. And so not realizing some of the ways that the US is different, the behaviors among the consumers and the retailers are different. They go in and they make a lot of mistakes. And the US is such a large market and such an expensive market in some cases to do business in, that it's very difficult to recover from expensive mistakes. And so getting help, engaging someone in the US that can help you sort of get through those initial phases so that you're not setting yourself up for failure from the beginning is super duper important, because the number of companies we see come into the market that think they know it all, having never done business in the US before, is actually very, very unfortunate. And the other thing is confirmation bias, where what confirmation bias is that you see one thing that reinforces your belief in how a market works or how your product will do in a market or what the market is expecting. And people tend to take that one thing and then extrapolate it to mean that everything they believe about the market or everything they believe about their product must be true. And so falling into the pit of confirmation bias is another way that we see customers tend to run into problems in North America. They have one early success with a specialty broker or a specialty buyer like a Sprouts or an H-E-B or a Whole Foods, and they presume that what that buyer wants is now going to map to the entire market with Kroger and Albertsons and all of the other major players, and that is also not always the case. So sort of not falling into the pit of thinking that one early success is going to tell you everything you need to know about doing business in America is another very important thing to keep in mind. So I like to give this example. This was the fastest client we ever had at the Opal Group from inception to failure. They were kind of forced onto us, if you will. Their investor group knew that the company was going to need help launching into America, so the investors engaged us and sort of foisted us onto the management team. And in the very first meeting, their CEO and founder sat down with us and said, "We don't need your advice. We already know the market and what we are doing." And 14 months later, they were out of business. And it wasn't for lack of having a good product. The product was actually excellent, and they continued to get messages on their Facebook page for quite a while after they had pulled out of the US market. It was everything else about how the US behaves. They signed some bad deals. They signed some paperwork without reading it. They got involved with some partners that generally we recommend you don't try to get involved in until you're a lot larger, and it basically bankrupted them in the United States in just over a year. So we have a saying with the US market, which is go big, go fast, go broke. because in the fast-moving consumer goods market in North America, there is very little recovery from mistakes. If you get so far out over your skis that you're into some of these retailers for 5-6 figures, it's difficult to dig out of that hole. So going into the market with a strategy, understanding what you're getting into, seeking advice before you sign paperwork is something you really want to consider doing. So what's another way? One of the big ways that people fail in the U.S. is being overly trusting of their sales teams. The U.S. is a huge, huge, huge market, and so you've probably spoken with, or if you're already in the market, you're dealing with a broker, and sales brokers are a sort of necessary evil in the U.S. because there's just too many companies, retailers, there's too much geographic distribution. And so what we see is these sales brokers typically tend to be buyers or people who came up through supply chain in one of the major retailers. And when they retire or leave those retailers, they join a brokerage and they continue to leverage those relationships by becoming sales brokers in the US. But sales brokers, any sort of salespeople, they tend to want to give you the positive news. They talk about the upside. They talk about the sales. They talk about all of the positive things that will happen. And so it's left to groups like the Opal Group who do back office operations or who do market analysis to deliver the bad news to you. And generally, people want to listen to the good news more than they want to listen to the bad news. And the brokers know this. And so if they spin a very good story for you, they'll convince you to do some things that may or may not be in your best interests, and believe that it's sometimes easier to gain forgiveness than prior approval. We actually had a broker sit across the table from us and say directly to me that manufacturers come and go, but if I lose my access to the retailer, I'm out of business. So whose side do you think I'm really on? So the brokers work for you. You're paying them, but you have to ask yourself, whose side are they really on when they're getting you into some of these deals? So making sure you've got a system of checks and balances, making sure you're validating what your brokers say to you. It's their responsibility to get your product onto the shelf, but it's your responsibility to get that product off. So making sure that you have a strategy for promoting your product, that you're getting into a market that you understand and that you know how to sell in is really important. And unfortunately, wishful thinking is not a plan. And so let's talk about investors and folks who tend to push you to go into the market. Don't let your venture capital group, your private equity group, your investors push you around by thinking that fast-moving consumer goods is a tech investment. It's not. Particularly since the dot-com boom in 2000, a lot of VC firms want everything to be like tech investments. They want everything to be disruptive. You go in, you go big, you disrupt the market, and you let the details sort themselves out later. And unfortunately, that doesn't work in consumer packaged goods. They are not a tech investment. It is, like Steve mentioned in his market statistics, it is a very methodical, slow growth industry, but the growth is there. So as long as you have a plan and as long as you go about this in a measured strategic fashion, it is actually very possible and not even all that difficult to grow your brand in North America. But trying to go big, trying to buy your way into distribution is not going to be a successful strategy. In fact, we did some estimates a couple years ago where unless you have about 15 to 18 million US dollars to spend, there is literally no way to buy nationwide distribution in the United States and stay on the shelves if you don't have a measured sales plan and a way to build velocity. Just going to the retailers and saying, tell me what your slotting is. I want to get into your want to get onto your shelves. If you try to do that on a national basis, you need to be prepared to spend between 15 and 18 million dollars minimal just to get on the shelves. Meatless Farms was a UK company. You may have heard they've recently gone bankrupt worldwide. They raised about $48 million, but they tried to be disruptive and go big in the US, and it bankrupted them. So having that plan, making your plan, I'm going to go in and spend a whole bunch of money and somehow I'll become successful after the fact, that's really not a good strategy in the US. Other ways that you can fail in the US is confusing your customer. There is a tendency to believe that US consumers will understand the same things that your home consumers will. And so the packaging doesn't necessarily tell you what's inside. The name is not particularly descriptive. Even the product name may describe a category of product that may not exist in the US. Particularly in Australia and New Zealand, it's very popular to have these like fig and date or date and nut balls. They're kind of like energy bars, but they're packaged in these spherical format. And when you go into the grocery store, there's entire shelves of just these boxes full of these nutrition balls, these sports balls that are really, really good. That category does not exist in the United States. And so when you sell a product like that into the United States, where is it going to be? Is it going to be with raisins and dried fruit? Is it going to be with cereals? Is it going to be with energy bars? Is it going to be with and so if you don't have a good answer to that question and you don't provide good guidance to the retailer, much less the consumer, this was a client of ours, and literally in every different chain, retail chain, and in some cases even in different stores within that chain, they were placed in a different place inside the store because the category they were selling into didn't exist, and they didn't provide any guidance whatsoever to their customers as to where it should be stocked. So building any type of velocity, building any type of brand awareness was very difficult because nobody knew where to find their product on a store-to-store basis. This is something that'll probably be near and dear to Steve's heart, which is competitive benchmarking. We always recommend that new entrants to the market do an honest competitive benchmark. What niche are you filling in the market? Why should a buyer put your product on their shelves as opposed to another product? And so we see a lot of competitive benchmarks like this example I put on the screen, where my product ticks all of these boxes, but all of these other ones only tick some of them. And if you're building this type of competitive benchmark, you're basically lying to yourself, because no product is going to tick all of the boxes if you are doing a legitimate competitive benchmark. You need to go in with a true, realistic understanding of what you can and what you can't do for the buyer, what you can and can't do for the chain, what you can and can't do for the consumer, and understanding that and having an honest assessment of your product and focusing on those areas where you truly provide value is what's going to allow you to succeed. If you go in thinking that you're the greatest thing since sliced bread and you are far superior in every aspect from price to quality than anything else that's currently on the shelves, it's possible that it's true, but you really want to take a very hard look at that, because the market will teach you the lesson that you have not taken the time to teach yourself in advance if you go into North America trying to do that. Don't presume that Americans will understand what your product is. These were 3 clients of ours. Ella's Kitchen, you may recognize, was a US company. We grew them from 0 to about 65 million in sales in the US before they were sold to Hain Celestial Group. And this product, Banana Baby Brekkie, no one in the US knows what brekkie is. It's not a term that is used. So they launched this product, and it received very good reviews in testing, but it just didn't sell. And so we did an analysis and took a look, and it really was, nobody knew what brekkie was. And so they changed the product name to Banana Baby Smoothie. And just by changing it to Banana Baby Smoothie, it became one of their top sellers in the US. It was the top seller in a number of retailers. So, being flexible, being willing to adapt your product to the market, even if it's something you feel is part of your identity, can sometimes be very, very important. We always tell new folks coming into the market, there are certain global markets like Japan and the Middle East where no one would argue with the need to localize your product, to adapt your product to the local market. And yet people come into the US and say, well, I'm trying to build a global brand. And that is like fingers on a chalkboard to us. There is probably no better indicator of failure than a company coming in and on day one saying, I am building a global brand and I'm going to do this the same thing the same way in every company, in every country worldwide. It just doesn't work. You have to adapt. Nando's Peri Peri, again, probably a product you are very familiar with. Nando's is all over the UK. Nobody in the US knows what peri peri is. And so they're actually in the process of changing their label to say Nando's hot sauce made with peri peri peppers, because hot sauce is obviously very well understood in the United States, but nowhere on this label does it say it's hot sauce, and nowhere on this label does it say that it's a marinade, except in tiny print and a recipe in the back. So, peri peri sauce, no one knew what peri peri sauce was. And so providing some descriptive terms, understanding what you're up against in the market. Cost and Press, another US company. In the US, press does not refer to pressed juices. It refers to newspapers. And so consumers were wondering why is a newspaper company selling me canned beverages in the checkout lane? So, just a little tweak to your label, shrinking the size of Cost and Press, increasing the size of sparkling water and juice, explaining what your product is can be a huge benefit to someone making that decision on the shelf to picking it up. Because if the biggest thing on your label is a brand name that your customers don't understand and don't recognize, they're not going to pick it up. This was a Finnish chocolate company that we launched in the US. And again, very high quality product. They were out of Finland. But the products that they chose to launch in the US were things like lingonberry and crunchy rye, sea buckthorn, spruce and hazelnut, flavors that maybe someone would pick up to try, but not something that your average American consumer is going to go back and buy over and over and over again. And so had they launched, some more quote unquote normal products or products that Americans expect, they could have built some serious velocity because the product was outstanding. And then they would have, these would have been kind of their loss leaders, if you will, that they would have sold, for people to have trial or for people to have novelty, because there is a market for that. But it's difficult to build a sustainable US business solely on novelty. And so if you don't have a variety of SKUs, if you don't have a way to build that velocity, to build that volume, it can be very difficult to succeed in the US. Another issue, another way that companies fail is by assuming that the US is kind of an if we build it, they will come type scenario. And so they put all of their money into trade spend, they put all of their money into slotting, they put all of their money into logistics and packaging, and they completely ignore marketing and advertising. As I mentioned earlier, it's your team's responsibility to get the product on the shelves. It's your broker's responsibility, the Opal Groups, other folks. We get your product onto the shelves, but it's your responsibility to get it off. And so, if you don't have a marketing plan, if you don't have a way to advertise and build brand awareness with consumers, you're tying one hand behind your back and making it very, very difficult to succeed. Because chances are when you initially launch, you're going to be placed really high on the shelves. You're not going to be mid-level sight lines. And so if people don't recognize your brand, if they don't recognize your label, if they don't have something to indicate to them this is why they should pick it off the shelves, it's very difficult to build velocity. Another thing is your form factor and understanding American behavior versus behavior overseas. In some overseas markets, it's typical for food to be seasoned in the kitchen with salt and pepper, whereas in America, it's typical for salt and pepper to be on the table. And so this was a low salt product, low sodium product that was really good. It didn't have that metallic flavor that some low sodium salts have. So we really loved the product, but we could not convince them to make a smaller form factor. They didn't want to go through and retool production line. They didn't want to go through a co-packer. So they're like, we're just gonna produce this big canister, and they didn't have a small form factor. And Americans don't season in the kitchen. Americans season at the table. So they got some sales to folks, who wanted to cook with it, but they couldn't build velocity because this is not how Americans behave. And we couldn't convince them to build a smaller form factor. And so actually, there's now one of their competitors came out with these smaller form factors and just literally ate their lunch in North America. Peanut Hottie, this is kind of a sad tale because if you are in a market where there's quotas or import restrictions to the U.S., you may decide you're going to co-pack and produce in North America, and that can be a very successful strategy. Rather than paying all of the shipping and paying import duties and sending something from overseas, there are a lot of very good U.S. co-packers, but you have to have a plan. You have to go in and approach this strategically. This product was a hot peanut drink. So just like you might make hot cocoa out of a package, pour it in, put hot water on top, this was a hot peanut drink. And as weird as that may sound, it was actually a very, very good product. It was really tasty. But peanuts are a quoted product. They didn't want to pay the import duty to do peanuts, so they decided to produce in America. And they decided that after they had already committed to a sale to their first customer, and their customer was pushing them, when are you going to ship? When are you going to ship? When are you going to ship? So they worked with a co-packer, they paid some extra fees to expedite, they got this product produced in North America and started shipping. And amongst other things, they actually managed to get a promo spot on the Today Show, which is a daily morning news show in the United States watched by millions and millions of people. Well, what they didn't realize was that the starch that they were using to provide some mouthfeel and thickening in the US did not behave the same way as the starch that they were using in their home market. And so live on national TV, they had mixed up this product and put it under the desk for the news anchors to try on camera and talk about the product. And instead of being a nice, smooth beverage like the original product was, the co-packed product, as it started to cool, set up into this gelatinous goo. And so live on TV to millions of people, the news anchors panned this product left, right, and sideways and were laughing about drinking peanut snot. It was absolutely disastrous, killed their product in North America because they rushed to co-pack because they had already committed to a US retailer before they had any of their infrastructure in the US set up. And last but not least, amongst my major topics today, do not underprice your product. Particularly your sales team, when they start talking to you, they're going to be like, boy, I don't know if you're going to sell at that price point. And you're going to get a lot of pressure from everyone, both on your own team as well as the buyers, to lower the price point, lower the price point, lower the price point. Stay strong. Price your product appropriately. This is a company, Fix and Fog, that were selling really high-end almond butters in their home market. They are a premium product, and they came into the U.S. and they priced their product equivalently to the Whole Foods 365 house brand. The private label. And in fact, when they were on promotion, they were $1 less than the private label. And for better or worse, US consumers use price as a signal of quality. And so if you are a premium product priced below the private label, you're going to have a hard time getting traction. People aren't going to trust your product as a quality product because of that price point. This is our local grocery chain here in Cleveland, Ohio, Giant Eagle. They're a Pittsburgh-based chain, so they're sort of all over this part of the Midwest. In the pasta sauce aisle, they have their private label brand selling for $1.59. They have the national brand Ragu selling for $2.50, and then they have this regional brand Pasta 2 selling for $7.99, $6.99 on promo. Which one of these do you think is the top-selling pasta sauce in Giant Eagle? It's the Pasta 2, the most expensive one. Not only because is it perceived as a quality product, and it's got a little bit of brand recognition because they do marketing throughout the US, but because in certain categories, Steve kind of alluded to this, there's a bifurcation. A lot of people are going to private label. There's not a stigma on private label anymore, but more people are cooking at home, particularly coming out of the pandemic, and so they want quality, and sometimes they want to treat themselves. And for better or worse, they use price as an indicator of quality. And so it's really these mass market, middle market brands that are suffering because private label is doing well and high-priced specialty products are doing well. And so not underpricing your product to try and compete with these national brands or, God forbid, the private label, don't fall into that trap. No one is ever going to argue with you if you decide to lower your price after you have launched in the market. But if you try to raise your price after you've launched in the market, everyone's going to fight you to the death. And including many of the distributors like UNFI and KeHE, they actually have terms in their contracts requiring up to 180 days of notice before you can take a price increase. But how often can you run a promo to lower your price or lower your price point overall? Do that at the drop of a hat anytime. So do not underprice your product in North America. You can set yourself up for failure, and this can be one of those expensive mistakes that it can be extremely difficult to get out from underneath. And last but not least, when it comes to pricing, trade promotion management. Trade spend and trade promotion management in the US is both nothing like you have ever encountered anywhere else in the world, as well as it's nothing like what it used to be in the US. Particularly if you have some older brokers who have been in the market for a long time, they're used to the market behaving one way. You used to be able to buy exclusivity where you would be the only thing on promo. You used to be able to do some things where when you did trade promotion spend, you would actually see measurable return on that investment. And now, that's not necessarily the case. In fact, many companies have found that they go on what they think is a really good promo and their sales actually go down. And then they're so confused. Why is that happening? Well, you do the market research and find out that one of your competitors was actually on a better sale than you were, just coincidentally at the same time, because no retailer is going to give you exclusivity anymore. This is an actual photo that I took in a local Giant Eagle of the nutraceuticals aisle, where literally every product in the aisle was on promo at the same time. And so, you see all these shelf tags and how do you differentiate? I mean, like what has that promo done for you? So not understanding how trade promotion works in the US, not understanding what it is, listening to a broker who just tells you, oh, just give them 15% once a quarter, you'll be fine. That's basically just a gift to the retailer if you don't have a strategy and understanding of how to do trade promotion management in the US. And so in closing, my final point is you're going to need third-party vendors and helpers in North America. You're going to need service providers. You're going to need warehouses. You're going to need freight brokers. You're going to need lots of different players to help you grow and gain a national footprint in the U.S. And many overseas brands come in and treat these third-party vendors as adversaries. They want, I'm going to get 3 freight quotes on every load that I send out, and they constantly try and beat people down on price. And that does not work to your advantage because warehousing is at a premium, broker time is at a premium. If you go and get 3 freight quotes on every load you send, the brokers very quickly are going to realize that they're doing all of this work to quote and build loads and only getting 1/3 the work. So all 3 of them are just going to jack their prices to you, recognizing that they're not going to get every one of your loads. You're going to end up paying more for freight by getting 3 freight quotes than you would if you just worked with a single freight broker and worked with them and occasionally go out and get another quote to keep them honest and make sure that they're the best freight company or freight broker to serve a new market you're going into. But basically abusing your third-party support team in the US is a really good way to go out of business because your costs will just skyrocket through the roof once people understand how you're going to behave in doing business with them. So my final parting words on this: revenue is vanity, profit is sanity. Coming into the US, do not focus on distribution. Don't try to go big, go fast, get into every retailer nationwide your first year in the market. Distribution means nothing. velocity means everything. Building those sales, making sure your product is profitable from day one, having a plan and sticking to it, that is the way to succeed in the US. So as scary as some of these things might be, and if I've planted any seeds of doubt in your mind of, boy, do I really want to launch in the US, hopefully it doesn't turn you off of the US market. There is a pot of gold at the end of this rainbow. You just have to walk towards it methodically and with a plan, and hopefully have some help in the marketplace to avoid some of these expensive mistakes that can really set you up for failure for the beginning. So thank you very much. If you want to learn more, hopefully I'll hear from you this summertime. We do actually have a white paper called 9 Things International Manufacturers Must Know Before Entering the US Market. If you go to our website, theopalgroup.com, and go to the consumer packaged goods area, you can download that white paper for free. So there's more info in there, and happy to speak with anyone anytime. So thank you very much, and turn it back over to Mel.
Fabulous. Thanks, Jim. That was really, really insightful. Thank you very much. I'm going to, just looking at time, I'm going to hand straight over to Michael, which will be really interesting to get an exporter's point of view on everything that both Jim and Steve have covered. So Michael works for Witt out of Chelsea. I'm sure many of you know him already. But yeah, he's going to sort of update us on what their brand has been doing in the States. Be interesting to see how their words resonate with him.
Well, first of all, I would say always trust your sales team. But hello, everyone. Thank you for inviting me to this session. It was really interesting, a couple of presentations, and really resonated with my experience over the last 3 and so years since I started looking after the US market. And there's some very important points here, and probably the one that really makes the most, that was the most important for me to also educate our business, is that it's not a market you can win within a year. You need to look at it as a long-term plan where you want to grow sustainably and build a brand, and not just build revenue. I think you can get overly excited with the scale of the opportunity, but the reality is, and especially, I mean, we are a known brand, we're still a relatively small business. We just can't go after everything straight away, and we can't spend millions on paying your way in. So what I've done 3 years ago, we had pretty much a white slate. I think the company over the last decades had in and outs in the USA, different ways. I think people still come to me with some stories of what we thought was 30 years ago. I think we had a coffee shop, a tea shop in Minnesota, inside of Macy's. So we did do things, but since we are owned by the same private equity company in 2010, the US has been not dormant, really. We didn't do anything. So when the CEO asked me to tackle the US market, it was a very exciting opportunity. But I did take my time. You need to really spend time researching, understanding, not just nationally, but regionally. Understand also your products and how it fits within the competitive landscape. Who's your customer? Who you're going to target? And not just going straight to the big volume retailers. I think, we spoke a lot over the last 45 minutes about grocery stores, but there are other customers who could be right for your product. So the moment you talk to big grocery retailers, it's very complicated. It takes a lot of money, a lot of risk, and risk that our company, for example, we're not ready to take yet. So it's about where can you win within your ability. And there are some companies, so understanding who would be your customer in terms of B2B customers is a first step, because there are some companies who would import your products directly. So you don't have to go through a distributor or a broker. They will want to find some interesting products internationally and bring it to their stores directly. So although there are some companies like that, they are quite limited. So at some point, depending what you want the US to be, how big you want it to get, you will have to think, how do I get to the next stage? So I find it's quite easy to get to $1 million in the US. It's how do you get to 10 million, 20 million, 30 million sustainably and profitably. That's what key, and that will take time for you to understand. So this is not a 1 year, 2 year journey. It's very much a 5 year minimum. Otherwise, by year 3, you're gone. So we spent a good 2 years doing some work with some direct to customer relationship. But then we get to the point where, for us to control the brand and to keep as much control over our supply chain, we had to make the step of actually having a first to build an entity here. And this is what we've done 2 months ago. So now we have Hotel of Chelsea Inc. We are incorporated in the United States. We are able to be our importer, and then we can really manage. We can have better control over the market and also the value chain of our product. You need partners here. So of course, yes, great that we can have stock here, we can have our own business here, but you will have to work with partners, and these are really important. So whether it's your 3PL, whether it's your broker, you need to find those partners. Don't jump on the first one that comes along, but make sure that there is very much a passion and energy that comes from them, that they want to help you succeed, want you to see you grow. So I appreciate we only have 5 minutes. I want to maybe keep a couple of minutes for questions, but essentially feel free to contact me. I'm very happy to share more on our journey. And we're still very much in the early stage of journey here. So fingers crossed. I've covered in my research. I've covered all the points that our 2 speakers spoke about. But you will make mistakes, that's for sure. So expect mistakes, but learn from them. Don't repeat them. And if you're not sure about something, there's plenty of people there to help you. Whether it's your industry colleagues or trade associations like the FDEA or or the Department of Business and Trade. So make sure you ask for help and you learn from people who've done it before you. Is that all right, man? Should I leave you a few minutes?
Yeah, thanks, Michael. I just wondered, just referring back to Jim's presentation regarding product adaptation, if you've had to sort of adapt a lot of your products for the US market.
Yes. Well, we had to adapt. We're adapting the language. So we do hot chocolate. We start referring more to hot cocoa. For the pack size as well, like our pack of tea, for example, come in 25 tea bags. The market is usually 18 to 20. So that impacts the positioning on the shelf. So we're looking to change the pack size in the USA. Same with the hot chocolates. Our hot chocolates run 50 grams. Most companies are between 200 and 300. So again, these little things are important. And the language around gifting. So even though we spoke a lot about grocery, there's some other companies out there who would be interested in your product if you can make it into a giftable item. So even though we have tea and hot chocolate, for everyday consumption, we do tins and beautiful tins for Christmas. And here it's all about the holidays, mostly focused on Thanksgiving. So again, we need to change our marketing plan and timeline to make sure we focus on the November sales and maybe less the December sales. So I think
Yeah. Okay, is anybody we are quite pushed for time, so just wanted to see if there's any further questions. If you want to put your camera on mute, if there's any questions for the panel. If not, then like I said, I will be sending round the webinar recording and the presentations from the speakers. We also recently had Gary Bayless from Registrar Corp do a presentation for us on FDA registration. So I'll include the webinar link to that, which might be of interest to you as well. Just one other thing to note is that we're talking to Steve at the moment about doing a possible online meet the buyer with some US buyers. So if this is something of interest, just while we're sort of working out the details, if you are interested, then just please do drop me a line and I'll make sure that you receive the information as and when we have that ready to launch. So just finally, thank you, Michael, joining us from the US.
Just on compliance, because that is such an important point. Understanding your product and how it's compliant in the US I mean, we did a first big deal with one of the big club business, like Costco and Walmart, and our compliance officer at least 1,000 emails just on compliance. So make sure you understand what ingredients you have and what problem is going to bring to the market, because it's a journey.
Yeah, yeah. I mean, I think that's pretty much what Gary was saying in his presentation, that if you're not, completely hot on it and all the changing regulations all the time, it can just be an absolute nightmare. So having, somebody that really knows what's happening in the market is so key. And that's where FDEA can help you with our connections as well. So Jim will be joining us, as he said, on the 5th of June at the Summer Network Forum. So hopefully you'll be able to attend that, and you can book that on the FDEA website. Tickets are now available to be bought. But yeah, just say thank you to all the speakers, Steve, Jim, Michael. Thank you so much for joining us in the US and the time difference, etc.
Pleasure.
Yes, so thank you very much, everyone, and have a great day.
Bye, everyone.
Thank you, Mel. Appreciate
Bye.
it. Bye-bye.
Sorry for going long.
That's okay.